And we, again, are quite honored to have Bill Strauss, who's the senior economist at the Chicago Federal Reserve, join us once again to give us a briefing on what is a very different economy than it was the last time we were pleased to have Bill with us. And we've talked about the tactics and the structure of deals, but of course the timing and the outlook is a critical factor. And the influences, both positive and some negative, that are affecting the economy, maybe impacting and affecting both the structure of the deals you do, the timing of the deals. And so we think it's important to have a holistic view and understanding of what's happening. And we couldn't be more delighted to have Bill Strauss here to give us an outlook on what's happening today and what types of metrics we might want to be watching in the future. So Bill, thanks again for joining us.
All right, thank you, William. And so curiously, how many of you were here last year? Wow, okay, so a lot of new faces. My very first slide is the fact that I was here last year, and this is what I concluded at the end of last year. So I'll move through it quickly since most of you weren't here. But I said that the outlook was for the economy to expand around a pace that we consider to be trend growth. That would be something that is just shy of 2%, 1.8 to 1.9%. That employment growth was expected to slow with the unemployment rate remaining below its natural rate. So we saw a bit better performance on both of these issues here. We saw the fact that the growth of the country itself came in a bit better than trend. Latest reading is a 2.5% economy for 2017. So that is somewhat better than just shy of 2% growth rate, but it's not substantially better. It's not, that exceptionally type of growth that some people have been talking about getting. That being said, the labor market, we added also quite a few people, as we'll see. But the unemployment rate has been below that natural rate, as I suggested. I said that the disappearing slack in the economy would lead to inflation rates that would be moving higher gradually, and it's probably been, all in all, too gradual from my standpoint, but it is moving higher. That manufacturing expected to increase at a rate below its trend. That was another one of the upside surprises, which is that it came in quite a bit better, and that was part of the strength that we have seen. In fact, the investment story that I talked about last year, the sense that we were on the verge of seeing an investment cycle that was going to be quite positive, certainly materialized, benefiting the manufacturing sector to a very stronger degree than even I thought. And that the housing market was anticipated to continue to improve at a modest pace through 2017, and that certainly continues to be the case. So, I teach a class over here. Matter of fact, I gave my final exam a week ago tonight. And I'm a tough grader, so I would say if I was going to give myself an evaluation, I'd probably give myself, a solid B, probably B plus on how this statement versus what we saw in the economy. Because we have continued to expand. As mentioned, the expansion has come in at 2.5%. We are in now the 9th year of our economic expansion. Keep in mind that historically, since World War II, our expansions have lasted just 5 years. So this one's getting long in the tooth. In fact, it's getting to that point where I think we need to start looking at some of these indicators that would be maybe suggestive of that R word, that recession scenario. It is not that economies run out of steam, right? There's absolutely nothing that I'm going to tell you today that's going to make you feel so good that tomorrow morning when you go to the office, you're going to put your feet up on your desk and say, I've made enough money. I can just chill. That's not how our economy works, right? We're constantly trying to do better for ourselves, our family, our coworkers, our businesses, and we grow. And we grow by roughly that trend growth of just shy of 2%. How does that number come about? It comes about the two ways any economy can grow. The first way is just looking at labor force, and labor force growth in the United States is just shy of 1%. About 0.8%. Half of it, by the way, is immigration. Half of it is native-born population. So with 0.8% more people, we have 0.8% more hands to do the work of the economy. And so our economic pie goes up by that amount. But while it's a larger economy, it's not a wealthier economy because while that pie is 0.8% bigger, you got 0.8% more people that want their slice of that pie. So it leaves living standards, in fact, unchanged. It is, but we know that living standards have improved. So how is that accomplished? By doing things more intelligently, smarter, effectively, what we call in economics productivity. The ability of producing more without needing to add a lot more assets. And those kind of things that lead to productivity improvements are different ways of doing business, like just-in-time inventory control, so something that came out of management school, led to a huge reduction in inventories needed in the economy, and that allowed us to become more effective, more productive. But of course, that couldn't have been accomplished without the technology of barcode scanning and computer systems and so forth. So certainly technology plays a major role, and just having machines to assist in terms of what you were doing, better quality machines, but also, you know, what the University of Chicago gets involved in, and all other schools, which is improving the skill of the worker, so improving what we call human capital. Doesn't mean that everybody has to go to a four-year school or a graduate school, but it does mean that to be effective, they need to have some bit of education. So in the US, it's regarded that productivity growth should be somewhere around a 1% growth rate, or maybe just a hair above 1%, which means that economic pie rises by 1% each year on average, without adding any workers. So therefore, the slice of the pie increases accordingly with that productivity growth. So again, we did better last year, but not impressively. So we are in the first quarter. In fact, we already have 2/3 of the first quarter out of the way, yet we will not know what happened in the first quarter until the end of April, when we get our first look at GDP, and then there'll be a couple of revisions, just like we just recently had a revision to the fourth quarter. So all of you are very busy, and many of you probably don't get as excited as I get when a new piece of statistical data comes out on the economy, like when we get the labor report tomorrow morning. I can't wait for 7:30 to take a look and see what that report shares for information. But if you're only going to look at one piece of information to kind of give you a sense of how the U.S. economy is doing relative to this trend, I would advise you to take note of an index which we calculate at the Chicago Fed using a fairly sophisticated model that is called the National Activity Index. So the CFNAI, Chicago Fed National Activity Index, is again available on our website, which is just chicagofed.org. The way you interpret this indicator is when it comes up with the number 0, it means the economy is basically growing at the rate it should grow at, trend rate. So the nice thing about this is twofold. Number one, it gives you a sense of what's happening in the economy relative to this trend. Number two, it's higher frequency than GDP. It is looking at monthly indicators. So in fact, that last data point we have up there is January. So we already have a sense of how 1/3 of the first quarter is looking like. And in fact, that number, I kind of like looking at the blue, which is a moving average of the last 3 months, or the red, which is just a monthly indicator, but both of them right now are just slightly above 0, suggesting that strength of growth continued into the first quarter, so we still grew. The growth rate was just a bit above trend, and in fact, probably a little slower than what we were seeing in December. So I would suggest that it looks like the economy in the first quarter is kind of doing what it's been doing now for a while, this somewhat above trend growth but no sense of acceleration. The current administration has talked about getting a 3% economy. This is certainly suggesting we're not seeing that kind of pressure yet. If that's something that is one of the goals. The good news is that we are still well above 0. Because when you go below 0, it doesn't mean you're in a recession. It does mean, though, that you're underperforming what the economy is capable of growing at. So if it goes below 0, we could think instead of growing at this near 2%, we're growing at maybe 1.5% or 1% growth, so underperforming what we should be able to do. But if it gets down too low, historically in a region about -0.7 to a -1.3 that I just added on there, you can see that it gets associated with one of those gray shaded areas because economic growth now has slipped into declines. So we're actually seeing declines in the economy, what we call a recession. So the good news is we are, with current data, far away from worrying about a recession, at least through January. The stock market had been on this tear for most of the past year. We saw a pullback in February, and I guess, quite frankly, the surprise, I would say, is just the fact that we didn't have any kind of pullback with consecutive monthly gains each and every month for the past year. And as you can see, it had a lot of volatility, but the net effect is we're still very high with regard to the gauge of the stock market. And so the way we think about this is its impact on consumer behavior. People are still looking at their 401ks. They're still thinking, I'm doing a lot better than I've done in a long time. This will generally translate into about a 2 or 3% spend, what we call the wealth effect. So it's not like if your holdings went up by $10,000, are you going to go out and spend $10,000, right? That was the whole problem with the housing crisis. People started extracting all of those gains as if they were permanent. People appreciate the fact that equity markets, as much as they can go up, they can go down. And therefore, they tend to be very, very cautious with treating it as a permanent increase. And so we generally take a small fraction and treat ourselves with that. So again, that's what's referred to as the wealth effect. So the fact that it has gained so much is, again, a positive into 2018. So what is happening? This is a little older news. So this is, the fact is that the Federal Open Market Committee, which is the monetary policy deliberating committee for the United States, meets 8 times a year at a minimum. And we got a meeting coming up in less than 2 weeks with an announcement. And at 4 of those meetings, every other meeting, we provide what is known as the Summary of Economic Projections, the SEP. What I have up here is our most recent SEP, which happens to have occurred in December, just ahead of the tax law change. Although I think when the numbers were being put together, it became pretty clear that the tax law was very likely to pass, and the framework of it, I think, was fairly clear at that time. So my point is, I think a lot of the tax law information is contained in this forecast. And in particular, I think I can say that because relative to the forecast in September that was made, this year's outlook was increased by 2 to 3/10% higher. And I think that's that stimulative effect that happened in that end of the year last year of getting that tax law change. So what is expected? Growth of 2.5% is expected for this year, roughly matching what we had last year. So there's still somewhat above trend growth for the U.S. economy, but not spectacular growth is what is anticipated. It's going to be interesting in a couple of weeks, basically 2 weeks from yesterday, the Fed will have its next meeting. And I can tell you that one of the things we'll be doing at the end of next week is working with our president, Charlie Evans, to put together what our numbers are for the key economic variables that we forecast, which is real GDP presented up here, the 2 measurements of inflation, top line and the core rate or underlying rate of inflation, the unemployment rate, and finally the federal funds rate. I'll be presenting all of those this afternoon. But the point is, you can go in roughly 2 weeks from now and take a look at how the Fed has altered their view with all of the tumults, perhaps, that we have seen, or let's go this way, information that we've acquired, both in terms of the volatility of the stock market in February, as well as this potential tariff issue, which I guess has been made more clear this afternoon. Something was signed, evidently excluding Canada and Mexico. I haven't read through it, so that's as much as I'm going to go forward on with regard to that. But we will be analyzing and thinking about what that might do with regard to the numbers. So the point is, in a couple of weeks, you'll be able to update these and kind of see how the Fed's view has changed with regard to this new information. But as you can see, going into next year, the Fed view is that this stimulus that we see probably coming off of the tax law change is temporary. We begin to revert back down where growth continues, but we get back down to more trend-like growth. We are in the 3rd longest expansion in our economic history, and if we continue to grow through the middle of next year, we will match the longest expansion, which is actually up here on the chart, that period of the 90s between this gray shaded area here and this one, 120 consecutive months of increases. So, and I think there's a good shot we can make that. I'll kind of go through some of the reasons why. Because one of the reasons is that this has been very much, as I characterize it, a tortoise-like economy. It's been that moderate and steady growth. It is not, we have not had any sector of our economy that seems to have jackrabbited ahead and gotten us into a position where we need to have a major adjustment to bring them back to normal, right? And I'm talking about the real side of the economy. We can argue about the financial markets, but in terms of the real side of the economy, all industries seem to still have what we call slack in them, room to expand without putting undue pressure. Maybe the only one I worried about, I talked about it last year, was the automotive side, which set a record in 2016, barely besting the previous record of 2015. And it was anticipated to see some pullback in that, and it certainly has. And so far, 2018 appears to be running a little softer than 2017. So we're seeing, again, even that sector dealing with this fairly well. What I have up here is to show you basically how this has been such a moderate expansion, is the previous expansions that have been seeing a deep downturn in the mid-70s and the early 80s, and I indexed the trough quarter of each of these cycles to be equal to 100. Blue is the current cycle, and then I ran out 34 quarters, 8.5 years, takes us up to the fourth quarter of this past year for the current cycle. And as you can see, at the end of the fourth quarter, we saw that our economy was roughly 20% bigger than it was at the beginning, 8.5 years earlier. But that is a pale comparison with what was accomplished in the earlier expansions when we saw growth rates that were 4.3% an annualized rate of growth, significantly above the 3% trend that was regarded for our economy back then. Bigger growth rate by 50% higher because of faster population growth and labor force growth because of all the baby boomers coming into work in the economy, plus the fact that we had a greater participation by women over this period. And then finally, we were a smaller economy, so productivity growth was regarded as a higher hurdle to get through. But still, we exceeded what we thought was trend by over a percentage point each and every year during the expansion. That is a vibrant expansion. What we've witnessed so far in 8.5 years has been a growth rate of just 2.2%, barely over that near 2% growth that we think of as trend. And that's why even in the ninth year of an expansion, we still have slack remaining in the economy. So I mentioned about looking at indicators for potential recession. I'm going to give you some market indicators. Here is one that is basically people's opinion, very smart people, the Survey of Professional Forecasters. They're asked, what do you think the probability of having a recession over the next 2 quarters, next 6 months? And what you can see is that, after the election, their view began to come down. It was viewed that the policies that were likely to be put in place probably put even less risk of a downturn occurring. And as you can see, the most recent number remains, all in all, quite low. Another one I like to look at, especially as we start thinking about these business cycles, is the index of economic indicators. And this one is they have the coincident, the lagging. This one is, I think, the one that we tend to focus more on, which is the leading economic indicators. This organization puts together basically these 10 series that seem to have leading properties. In other words, they tend to start moving down roughly 6 to 9 months before the economy begins to show economic distress, economic declines. And you can see that pretty consistently, where before the gray shaded areas, we see declines occurring in the index of leading economic indicators. Most recent month we have is January, and it, just like the National Activity Index shows, it was a good month. In fact, the index of economic indicators set another all-time high. So no sense of a decline yet. We'll see what the stock market does when February comes out. The stock market is one of those early indicators, but it's just one of the 10. So we'll have to just keep an eye on this, but so far, looking at what we're seeing from these, there's no reason to worry about a recession. With regard to the labor market, I mentioned the fact that we're adding a lot of workers, and this has been quite a bit of a surprise because, again, demographically, it should be a number below 1%, which would, we're at double that, 1.5% we've been adding workers. You can't continue to do that when you don't have the pool of workers to draw from. I think part of what's going on is that I think there are people that are sticking around in the workforce longer than historically expected. This has been a general trend for older workers to continue to work longer. We're living longer, and more of a service-based economy encourages greater participation longer in life. But I think that especially for those individuals who were damaged during the financial crisis, especially those who had a lot of their assets tied up in their home value, a lot of people who maybe were expecting to get bonuses and to have, start saving when they were in their 50s, and then the financial crisis came and they saw their employment disrupted or maybe their income disrupted to some degree. Well, the solution to that, if you're kind of behind the curve of where you want to be, simple solution is instead of retiring at a certain age, you delay that by a few years. That's a few years less that you have to draw off your savings to live in retirement, and you contribute more towards that retirement level. So that certainly could be partly what's going on here with regard to that. But again, it has been moving down. My point is it's probably been surprising to many of us that it's gone down as slow as it has, because the unemployment rate is really low. 4.1%. This is well below the roughly 4.5% that we think of as the natural rate of unemployment. And yet, with all of this, you would think we should be seeing wage pressures, right? When you hear from businesses, you can't find qualified workers. The answer to that is, well, if you can't find qualified workers in the pool of workers that are unemployed, we all know where to find those qualified workers. They're at your competitors. And what you do is you go and you talk to them or have them come and talk to you. And the way you attract them, as we all know, is that you make them a nice offer, an offer they can't refuse. Better benefits, better wages, and you get them to move over. And of course, that leads to that company they left having the same problem that you were dealing with. So they have to go through this effort. And as we start seeing churn in the market, as people begin to move around to get those better wages and benefits, that is usually a signal to many firms to say, oh, we're getting a lot more turnover than normal. Maybe we had not kept up with the market wage, and therefore we start to see greater pressure. Anyway, point is, we're not seeing that in the data. Yeah, the green line there, you can kind of see it's been edging higher. The red line is benefits. But still, we're looking at 2.5%, and this is as of the fourth quarter, on a year-over-year basis. And this is nominal. So take out inflation, 1.5%, 1.75% inflation. You're talking about real wage gains that are less than 1%. Very unusual when you have unemployment rates as low as we have, and given the point of the business cycle that we are currently in. Part of my story, which again is all tied up with what I expect to see on investment, is the fact that expectations are that wages will be seeing continued pressure, and they're more likely going higher than anything else. Here I'm linking up the National Federation of Independent Businesses, which is in blue. The green line is that same indicator that we had on the previous chart, wages and salaries. And what you can see is I pulled back the blue line by 9 months. It has some leading properties. So what you can see is that traditionally, when the blue line, which is the NFIB question on, do you plan on increasing compensation to your workers, you can see that when they say yes and they kind of goes higher, it corresponds with about 9 months later, an increasing pressure on wages. Where you can see where we are right now is that it has diverged, where the survey is saying wages or compensation should be moving higher, yet we're not seeing it in the data. So I think that, how do we correct this? Either the blue is wrong or the green is wrong. And I think my view is we're going to see a lot more of the movement of the wage and salary up to that blue line going forward. Unemployment rates are expected to remain very low at this reading of just around 4%. So well below what the Fed views as 4.4 to 4.7% as the natural rate. So that's interesting. With the economy still growing, although again, not spectacularly, the Fed right now is telling you that we are going to be willing to tolerate a labor market that is remaining what we would normally consider to be overheated, below the natural rate. And we're as you'll see at the very end, the policy the Fed is suggesting is still to have no contractionary type of policy. So let me kind of square the circle on what's going on with the labor market, because as I kind of mentioned earlier, standards of living are based on productivity. So really when your real increases are based upon what you are able to contribute. And I think the story of why we have seen little wage increases is the fact that productivity has suffered. Now, productivity bounces around quite a bit, and that's why what I've done with this chart here is done a 5-year moving average. So that's a really long time period. So the way you interpret this is that last data point on there, which is the fourth quarter, is not the fourth quarter number. That is the last 5 years worth of productivity up until the fourth quarter. And as you can see, it is well below that 1% number. And in fact, you can see it's been well below 1% for years, 2 or 3 years now. So really, this productivity growth being really weak is a story that's been going on now for 7 to 8 years. And I think it's that weakness in productivity that is the reason why we haven't seen the compensating increases in wages and salary. Why has it been so weak? Well, as I mentioned, one of the key factors underlying productivity is giving the workers the tools to do the job effectively. And we have seen investment that has struggled throughout this expansion. In fact, in 2016, reaching a level where it went negative. We actually had less investment in 2016 than we did the previous year. Now, investment goes negative, but that normally occurs during a recession. When you've got pieces of machinery that are sitting idle for lack of demand, you're not about to go out and buy more machinery to sit idle. You wait until that machinery gets used a bit more, and then capacity utilization rises, and then you go ahead and you splurge on additional investment. But the very fact that during an expansion we start to go negative is really very, very unusual. So what's the story there? I think it's the fact that during the economic downturn, over 6% of workers lost their jobs. We had an oversupply of available workers. They weren't costing very much. Nearly 9 million people lost their job. We weren't costing very much. And if a firm has to choose, how do I accomplish this moderate GDP of just 2.2%? How do I accomplish that? You got two options. Hire more workers to do those extra output, buy a piece of machinery. Well, if you got the workers, it's a much safer bet. Because if we happen to go into a recession, and remember, coming out of the financial crisis, people were really scared about what the economy was going to look like. I think most people would be surprised that we're now in the third longest expansion in U.S. history. I don't think they would have thought that. Matter of fact, I remember holding meetings where people talk about we're in a death spiral during the downturn. So the very fact that you talk about, third longest expansion coming out of it, I don't think they were thinking that. And therefore, if we go into a recession, as many of them were thinking, it's like if you have workers, you just get rid of them. Our flexible labor market allows you to shed those workers and the costs go away. Whereas if you bought a piece of equipment, now you're saddled with that piece of equipment, and technology-wise, it's probably even more sophisticated than ever before, deteriorating even more quickly than in the past, and it's sitting idle. So the fact that we had so many workers, you were able to, even right now, 1.5% growth in the labor market, you can get 1.5% of your gain of your output. You only need another 0.5% or so up to get up to that 2.2% or so. So it doesn't take a lot of investment. But as I said last year, I thought the game's coming to an end. And we're going to see wages going higher. I think business, and now with the growth doing even stronger than that 2.2, I think there's real justification for investment. In fact, the last 4 bars over there are 2017. Impressive growth for investment. And I think we're likely to see that continue into 2018 and potentially into 2019. So I am all in all upbeat on that. And it has allowed productivity growth to come back. As you can see, the more recent data, this is the year-over-year performance of productivity, it too went negative as we saw this collapse of investment of a year ago. But now with the investment cycle coming back, we're seeing productivity growth improve. And I think that's going to be very important, because if productivity growth is coming back, and coming back with maybe even a bit more gusto than its historical average of around 1% or so, it means that you could afford to pay workers more, and it doesn't necessarily mean that it's going to translate into higher prices for the product or hurt in terms of the bottom line on profitability. So if your workers all of a sudden become 3% more productive, you can afford to pay them 2% more real wage gains, and you still are ahead of the game. So inflation. As mentioned, inflation is kind of edging higher, certainly not getting out of hand, and this is the latest data through January, but still below the 2%. The business cycle it's not even a business cycle, but the cycles of energy prices have been very dramatic. Another positive going forward is the fact that the oil prices are around $60 a barrel, so a lot of investment in the energy sector continues to do quite well. But nonetheless, that has put some pressure on prices. Still, though, when you look at what does it contribute to the bottom line of consumers, so I love this chart here. This is the consumer spend on energy goods and services. So it is filling up your vehicles, paying your electric bill, paying your heating bill, all the things you spend directly on energy. And what you can see out of this is that right now, well, as of January, it's a little over 4 cents out of every dollar spent. And from a historical position, the current decade we are in is the lowest decade in the last 60 years. And in fact, the current position is even lower than this decade average that we're currently in, which is those red bars. So basically, energy is really low, really, I hate to use the word cheap. My former mother-in-law said never use the word cheap. It defines something about quality, but it's really inexpensive. So let me pay tribute to her. So I'll give you, if you don't believe me, I'll give you some proof of this and how it's affecting markets in just a minute. Removing the food and energy prices, the underlying rate of inflation, it's not that the Fed doesn't track food and energy prices, but we know that it goes through these wild cycles that might have nothing to do with the underlying business cycle, so we separate it out, we pay attention to both. But as you can see, the underlying rate of inflation has been, in fact, even a bit weaker, in part because it's been an energy strength in the last year that has pushed up those prices to somewhat. But again, what is the Fed expecting? We think that with the slack in the economy finally getting removed after now approaching 9 years of growth, we'll be seeing inflation rates that get up to the Fed target of 2% this year and then hang out at that roughly 2% over the next several years. So we don't see anything that is altering that. It'll be interesting when we do our analysis, because one aspect of the tariff is the fact that it adds some potential inflation risks to the economy, as we are paying more for goods that we will be importing, and our domestic producers will be able to have more pricing power to charge their customers more with having less price competition from those imports. So it does have some inflation issues that we'll have to be thinking about, and that's so I would be looking at this chart in a couple of weeks to see how the Fed has altered their view with regard to the inflation path, which I would say would be largely reflective of perhaps this tariff that we're dealing with. The underlying rate of inflation is expected to also be roughly the same kind of pattern. So what do you take out of that? That the Fed is expecting no big difference between oil and food prices or energy and food prices compared to the underlying rate of inflation. I hate this chart. So William is hopefully going to post these. You'll have it available to look at this. But what this is, and you can look it on your own, this is the blue chip forecast for where they see growth around the world. And the first three columns there are the GDP growth rates around the world. And what you could see there is that this story of the U.S. doing moderately better is a global story. Most countries are forecast to see some upside growth relative to what they have been doing. But nobody is being forecast to have exceptional growth. So in other words, it doesn't appear that we're having any kind of hot spot in the world's economy. In fact, the next set of three columns is the inflation rate. And again, you can see there that inflation rates are not anticipated to get out of hand around the world. From a monetary policy standpoint, that's something else to think about on the inflation front. If we're talking about a domestic economy that doesn't seem to be dealing with a lot of inflationary pressure, the question is, could you begin to import inflation if you have one part of the world that is getting overheated, a bit too ahead of itself? And then the goods, they start bidding up prices of commodities and other goods, and then you wind up bringing those goods in, you could then be bringing in some inflation aspect. Point is, looking at these numbers, if these are true, little risk of that. Manufacturing, which has benefited the Midwest economy in particular with our machinery perspective, is also a global phenomenon where we're seeing improved performance. The green is above trend. And the top area there is the NAFTA zone, and you can see Canada and the US has been in the green now for quite a while. And the middle section there is Europe, which has actually been doing quite well for a year at this point. And even Asia, which is towards the bottom there, are doing better than they were, although still probably not as well as other parts of the world, but certainly better than what they were doing a year ago. So the point is, we're seeing this relative better performance around the world. The top line is the World Manufacturing Index for the purchasing managers, and it's been above trend now for 4 months in a row. And again, improved from what we had seen previously. The housing sector is expected, according to this blue chip is these, again, 50 professional forecasters. They're seeing just shy of 1.3 million housing starts for this year. That includes apartments, condos, single family, so ownership, rental, everything's included here. For next year, 1.325 million. So still shy of the roughly 1.4 to 1.5 million that we think of as a more normal, demographically based, given household formation, number that we should be generating. So given that this was the industry that really took us down during the financial crisis, we're now well over 10 years since they started this collapse of theirs. They're still not back to normal, even according to Blue Chip next year. So we'll have to maybe wait until 2020 to see normalization of this market. I mentioned that the industrial sector is doing well around the world and in the US. We're finally seeing growth occurring. But again, it's growth that is somewhat above trend, but again, not impressive. Capacity utilization rates have moved higher. In fact, in December, we had the highest reading that we have seen during the entire expansion. And I think that, again, is contributing towards this view of we should be investing more, that we're using what we have available to us, higher degree, more investment should take place. But it's still below what is considered to be full utilization. I talked about the auto industry, and auto was a very interesting story. As I mentioned last year, the view was that the industry was going to have some pullback of sales, probably around 1% or just a little over 1%. Was expected. Well, for the first 8 months, the declines were much more substantial, at over 2% pullback. So the industry was planning on a 1% decline. It was a more than 2% decline. So production rates did not cut back enough. So by the end of the summer, we began to see days supply and inventories that were rising. And the industry was talking during the summer, all right, which plants should we be shutting down for some extended shutdowns, a week here, a couple of weeks there, to deal with this excess supply? Well, then we had the hurricanes. Harvey, Irma came through, and as much devastation that they did, especially to the chemical and oil-producing sectors, but the people's lives, their homes, lives lost. With all that, I can't help but think that the people in Detroit were kind of high-fiving each other, because estimates are that 500,000 to 1 million vehicles were damaged or destroyed by the hurricanes. And you can see what happened shortly after that. That next pop up there was the fact that we had this replacement demand and remained very, very strong through the end of the year. It's pulled back more recently at this roughly 17 million rate for January and February. But again, still pretty solid. But nonetheless, sales fell by 1.4% for the year as a whole. So a bit, or very close to what the industry was expecting. But again, it took a hurricane to get their numbers right. But it depends upon what product you were selling when you talk about a decline. And because when you look at the industry, if you were selling trucks and producing trucks, you were like, what slowdown? We were busier than ever. In fact, sales for light trucks, which includes pickups, sport utility vehicles, crossover vehicles, was up by 5% last year. Passenger cars, down double digit. And in fact, in February, we hit another record high. It says January up there, but February, we basically matched it. And so we have 2/3 of the market in the United States is made up of light trucks. That we have flipped on its head. If you look at the early part of the chart, go back to early 90s, and it was 1/3 was light trucks. Now it's 2/3 is light trucks. So the whole market has been completely. What's driving that? I heard it. Yeah, inexpensive. Learn that lesson. Yes, inexpensive gasoline. I mean, people are saying when they do surveys of what are the factors that you think about when buying your next vehicle, when gasoline prices were at $4 or $5 a gallon, that was up there. Fuel economy, that was up there. Now it barely makes the top 10. That's the least that people think about. They want the space, the comfort, and everything else, which is what a SUV-like product, a light truck product gives you. All right. So let's look at another part of the auto market. I was just out at a Ward's Automotive Conference yesterday. We were talking about some of these issues. How many of you drive in? Well, before I do, how many of you consider yourselves environmentalists? Very few hands. I'm not surprised. Nonetheless, how many of you drive an all-electric vehicle? Just, I mean, was it a Tesla or a Leaf or a Bolt? Just one. Oh, I would have thought that with this well-dressed group here. Just one. Kind of strange. How about hybrid? Oh, come on. All right, so all of you have your hands up as environmentalists. You speak with forked tongue. I don't mean to say that to anybody, but everybody who didn't put your hand up, you're the blue line there. And that top line is 100%. And that's current selling rates. That has nothing to do with the industry part, which is 250 million vehicles. These are just the new products coming into the market. 97% of the market are internal combustion engines, gasoline and diesel. The green line is everything else. It's all electric, it's hybrids, plug-in or others. It is hydrogen-powered, wind-powered, solar-powered, gravity if you put it on a hill. Now, I might be doing that old, lying with statistics, right? We got things on two very different scales. Look how small that is. It's a nascent industry. So let me show you what happened. It is a nascent industry. Began with the Toyota Prius coming into the market in the early 2000s. Then it gained some market share. And then it got as high as around a 4% share for all of these alternative products when gasoline was at that $4 to $5 a gallon price tag. And then energy prices collapsed from $107 a barrel down to, very low, 40, 28, to I think it went down to 26 as a low. And you can see what happened to the market share. And currently, it's barely over 3%. So the suggestion that we're moving rapidly towards this electrification of the fleet is a bit of a pipe dream. What is happening on the vehicle sales? As expected, as mentioned, it's expected to see some continued moderate pullback. Still, if they control this, it'll be a very profitable time for this industry. This is just a heat map. Again, with the key things you can look at your own. The top line there is just the overall, and you can see it's been green. The red that was preceding it, that was the hurricanes. Because if you look down to the bottom, where it talks about petroleum and chemical, it was red, severely red during that period as we saw the shutdowns. So what is expected? Decent numbers, around trend or just shy of trend for this year, a little bit below trend for next year. The industry will take this in a heartbeat. Let me close off by looking at the financial markets and Fed policy. So I love some of these indicators for, again, sensing on interpretation of what's going on in the economy. In particular, I love this credit spread, which, as many of you are aware, is the difference between two interest rates. These are same type of product, corporate bond, but by two issuers. Best companies out there, corporate AAA, worst companies out there, junk bonds, high yield securities. And so if you're worried about a recession, you're going to begin to worry about those risky companies going out of business. So you tend to want to charge them more, ask for a higher interest rate in order to compensate you for that additional risk. So as this indicator goes higher, which is the difference between those two, it's indicative of a market that's assessing greater risk of a downturn or challenges in the economy. You could see it during the financial crisis where it skyrocketed up to 17%. You could even see it in 2011 when the US government downgraded from AAA to AA plus. And then the rise of ISIS and the beheadings and all that, and back in 2016. Point is, what we have seen most recently, and this is data as of yesterday, so even with all the talk of the tariffs, I was kind of watching this to see whether these markets would be edging a bit higher, moving a bit higher. Not seeing that. And I happen to like this kind of an indicator because it's one thing to have an opinion and to express it. But when you are, it's kind of like when you're in Vegas, right? You're in Vegas, you're not just thinking what the next card is going to be pulled or what that next marble is going to land on. When you actually go to Vegas and you put money on the table, you're backing your view with dollars. So you really have a commitment to that. And so this kind of commitment, I think, is important for understanding the value of this particular market. So again, I'm looking at this market, I'm saying, the market was not reacting very much to the trade issue. Now that it's been signed, maybe they'll take a different view. Maybe they just weren't willing to commit, given that we had a lot of uncertainty. So something good to monitor. Many of you are aware of the inverting of the yield curve. So this is the fact that longer interest rates tend to be higher than shorter one because of the inflation risk that's associated with it. And you can see that when the yield curve inverts, goes negative, it is followed shortly by a recession. So one thing that I took any positive note out of the volatility that began in the marketplace, in particular, at the early part of February, it was because the 10-year was moving higher than what a lot of people were expecting. So I took that with if the market's going to have some turmoil, let it be for a good reason. And from my view, it was a good reason. In fact, you can see that in February, this indicator actually moved a bit higher. So we're moving away from this risk of inversion. That being said, even before all of this, the blue chip was saying at the middle or early part of February that they don't think that we're at risk of an inversion. They think it'll flatten further, but still, even by the end of next year, remain very positive. So the Fed has been increasing interest rates, increasing them at a moderate pace, just 5 rate increases since the end of 2015. What is the Fed planning on doing? Well, as of the December forecast, we're saying 3 rate moves this year. We've already had 1 meeting. We did not increase rates. We've got another one coming up in a couple of weeks. And so we'll have to wait on that. But you can see that the increases continue to rise, but they reach that level, that blue shaded area, sometime at the end of next year and remain there. So we're not expecting to see it get above that. In other words, all the Fed is doing is removing the accommodation. We're taking our foot off the accelerator. We're not applying the brakes. My last slide here is our balance sheet. So part of the normalization of Fed policy, which again, on the Fed funds we should reach by the end of next year, is trying to deal with this exceptionally large balance sheet that the Fed has acquired, from $800 billion to $4 trillion. And last year, the middle of last year, we announced we would begin to do some reductions. And then in September, we stated the fact that we would begin in October losing about $10 billion, letting $10 billion roll off the balance sheet each month during the fourth quarter. Yeah, I can't even see it on the chart. We increased that to $20 billion, so we're starting off slow, increasing that. $20 billion in the first quarter. If you look at the very end of that chart, you can begin to finally see a little bit of it rolling off. In the second quarter, it's going to go up to $30 billion. Third quarter, 40 billion. You see where I'm going. Fourth quarter goes up to 50 billion a month, roughly matching what the normal roll-off would be for maturing securities on our balance sheet. So the point is that we should see this go down quite a bit faster as we move through, assuming that the market is able to deal with this additional amount of purchases, since the Fed will not be participating. That's why we're doing it on the slow, and we don't want a taper tantrum type of event, so we're monitoring it closely. So in conclusion, we're looking at an economy which is going to be all in all quite decent, probably my most optimistic outlook that I've had for quite a few years, of above trend growth that is somewhat above trend, not spectacular, and with the fact that a lot of our sectors are getting themselves into a more balanced position. That will then also begin to put a lot of pressure on fiscal and monetary policy to make sure that you don't do things that are overly stimulative when you got your economy that's kind of at that position of full utilization. You've got to be very cautious about that. So it's been a pleasure joining you, and I don't know if we have time for a question or two. Appreciate it. Yes, sir.
What's your view on risks posed by level of debt in the economy and asset bubbles?
So the question is, what about the risks that are posed by the leveraged debt? Are you referring to private debt?
Private, public.
So, I think the public debt is a big concern. And it's going to be interesting how the fiscal side deals with the fact that the publicly held debt is something around 80% of GDP. That as the interest rates begin to get adjusted, as we're seeing them moving higher, that will mean that the interest share of the budget, the federal budget, is increasing, and how they deal with that is going to put a lot of pressure on their programs or tax position. With regard to the private sector, we're monitoring that. For the most part, I would say there's not too much concern. And I say that because there has been, in general, a hesitancy to want to borrow, especially for this investment story. And so I think we're starting to see balance sheets start to offer up some additional purchases there. And the second question you had was?
About asset bubbles.
About asset bubbles. Always a concern. So, you got to be cautious because, Paul Samuelson back in the 60s famously said that, the stock market has predicted 9 out of the past 6 recessions. It's an overpredictor. Just like in 1987, we had remember Black Monday, 1987, massive crash, 25% of the value of the stock market disappeared, and we avoided a recession, in part because of good policy by the Fed to put accommodation in place very quickly. But so you have to be very careful. But it is a risk, and again, it is, as I mentioned, one of the leading economic indicators. So it's not like it has no power and no suggestion, but it's not the one and only thing that we have to focus on. But in terms of predicting an asset bubble, that I'm going to stay away from. Maybe one more? Yes.
One chart that was interesting early on was the
Only one?
Chicago Activity Index.
Yeah, National Activity Index, yeah.
So if you look at the current expansion, the frequency or
Shoot.
volatility is
Blew
muted
that.
compared to the prior two recoveries that you showed on the chart.
I'm sorry, I got confused. I thought
So the volatility
Yeah.
of that metric during this recovery has been materially less or lower than the prior two recoveries. So what's like the right interpretation take on that?
Yeah, so the question is about this volatility. And again, I think that not only the National Activity Index can you see that, but you could also see it with regard to the GDP growth rates and the fact of how we're tracking. This has been very modest and very, very low frequency expansion. Why? I'm going to come back down to my story about investment. About 88 to 90% of the swings in GDP are attributable to the durable goods sector of the United States. So people buying vehicles, businesses buying equipment, and we have seen, all in all, very little volatility and very low activity in all of those. So I think that's part of what answers that question. All right, one more.
What do you see as the biggest risk to global growth or American growth in the future?
So I think, and actually I like the way you phrased it, global growth, because I think domestically we're looking pretty good, unless we shoot ourselves in the foot doing bad fiscal or bad monetary policy. Hopefully we don't do that, or as mentioned, something with the equity markets. Short of that, I think we have to look outside the United States for most of the concerns. And the one that has always been on my radar has been China, in large part because of the way it has organized its activity, which is not using market principles, but using people making judgments on where investment should go. And at some point, I think that those ill-found investments have to be dealt with. And it's going to be very costly to do that. I often look at what China is dealing with, and it's kind of like when we have visitors come over from China, I'll tell them that you guys in the United States, we have the same problems in terms of aging population, pollution, so many things, but they have it far worse. Income inequality, they have it far worse. So I'm very concerned about how they are able to manage all these problems with an economy that is now really beginning to slow. Okay, thank you. Quick.
I was just going to ask you about the federal budget deficit.
Yeah, I mean, so with the federal budget deficit, I already kind of mentioned it's going to be increasing pressure on the budget. I would just say that I'm not concerned about that for the next 2 or 3 years, which is kind of my outlook that I'm doing today. But if I was talking about a 5 to 10 year horizon, it's definitely up there in the top, probably 2 to 3 issues that I worry about.